Hello everyone, welcome back to my channel. So as you know, you can benefit out of this channel with videos that will help you in your day-to-day coursework and assignments related to business, accounting and economics. So I hope you will find this video useful, and if you have not yet subscribed to my channel, please do subscribe, and you can comment below on your views and any suggestions on the video. So with that being said, let me introduce you to today's topic. Today we're going to discuss about the process of accounting. When it comes to the process of accounting that we're going to discuss here, we're going to give a very brief outline of the whole accounting process at a glance. And this video is targeted mainly for beginners to have an idea about the whole of accounting process, which is usually the subject content of Igcse. So talking about the accounting process, first we can look at what is this accounting process and why do we need it. So talking about the accounting process, the need for accounting for business is actually for five main purposes. First of all, we need accounting to keep a systematic record of the business transactions. So we basically need to know what's happening in a business. When we talk about business transactions, any exchanges that are happening in monetary terms need to be recorded in accounting. So basically, for the owner of a business or for any other stakeholder, any person who's involved in business, to know about what's happening in the business and how does money come in, how does money flow, what kind of profit they've made, what's the cash situation now, is it good to expand, etc. So to know these things, they need to have a record of what's happening. So to do that, accounting is needed. So that's the first main reason why we need this accounting process, and that's why there are so many accounting related occupations born, and that's why there is a department called the accounts department in most of the organizations. So that's one of the main reasons. Secondly, for a business to calculate the profit or loss, to know at the end of a month or at the end of a certain time period whether the business has earned a profit or loss, we need to have accounting. And also to know the reason why the business is having such a profit or loss. This is especially important to decide the future plans of a business, because usually when it comes to businesses, initially they start with losses and then break even and move on to profits. So in this growth stage, in this life cycle, definitely a business has to monitor from the starting point the level of losses, the reasons for the losses, and they have to try to minimize the losses as soon as possible and turn them into profits at the right time. So to decide the strategies for this, we need accounting to know the exact reason behind this profit or losses. So that's the third reason why we need accounting. And also to ascertain the financial position of the business, we need accounting to know where exactly does the business stand, whether it's in a good financially stable situation or not. And finally, to provide information to various users, to give information to the lenders, to give information to suppliers, to give information to anyone who's interested in working in the business, etc. So for all of these purposes, accounting is required, and that is why today we're going to look at what is accounting, because accounting is such an important process for businesses. So talking about what's accounting, it is actually a 5-step process. In accounting, first, we need to identify the transactions. That means we need to see what kind of exchanges have taken place in a business, then we need to record them by giving them values. If they are not directly dealing with monetary values, sometimes we need to make estimates, approximations, etc. Whichever the case, we need to first identify the transactions we have to focus on, and then we need to record them properly, and then we need to summarize to have an idea on what has happened so far, and we need to analyze it. We need to look at the situation based on the summaries we've prepared, and we have to communicate it to the relevant authorities, may it be the manager, may it be the department head, etc. Because these information about the transactions for business are going to be used in the strategic planning of the business, in deciding what they're going to do next and avoiding any operational problems. So therefore, according to what you see on screen, I think you have got an idea that basically accounting is a process that deals with transactions. So basically identifying, recording, summarizing, analyzing, and communicating the transactions for business is they're the key steps of the accounting process. So if you're studying accounting as a subject, maybe at college, maybe at Igcse or A-levels, so these are the main things you're going to learn to do. You're going to learn how to identify the business transactions, you're going to learn how to record them, summarize them, how to analyze them, and how to communicate them. And practically this is going to help you out really if you're going to do business, or if you're going to be part of any business, this is going to help you pretty sure. Taking step by step the process, first let's see, what do you mean by identifying transactions? So what we need to do is we need to see, okay, what are the transactions that have taken place in a business? For example, one such exchange that could have happened is a manager putting an advertisement to recruit an employee. It is a transaction because it's an exchange of information, but it doesn't deal with money. So we are not going to consider it as a transaction that's important for accounting. But the manager paying for the advertisement, paying $2,000 for the advertisement, well, that is a business transaction that you need to record in accounting. So the first step you need to do is you need to see whether these transactions affect the business monetarily, whether it affects the value of the business monetarily. And if that is the case, definitely it's going to be recorded in accounting, right? So basically, the first stage of the accounting process is identifying any transactions that can be given a monetary value. And these transactions need to be 100% confirmed. When I say 100% confirmed, that means we need to have clear evidence that this transaction or this exchange has taken place. So that's the first step. And when you talk about the transactions, as I mentioned before, we need to be well aware of recordable and non-recordable transactions, about the transaction that we need to really focus in accounting. So, for example, as you can see on the table, the salary is paid to a new employee. You need to record it because it deals with money. Buying a new machine on credit, you need to record it because someday you need to pay it. Relocation costs, once again the same. But consider transactions like a new employee is recruited. The recruitment, unless there's a cost involved in the transactions, of course it's not anything that accounting has to concern with. Or the business decides to buy a new machine. It's nothing that accounting has to be concerned. But if the business buys the new machine by spending money, or if they buy on credit, then they have to be concerned of. So this is how you differentiate between what you need to record and what you don't need to record in accounting. So I hope the first step of the accounting process is quite clear for all of you. So right now, having told about the first step of the accounting process, I would like all of you to take a few minutes, think of 2 transactions that are recordable in accounting and non-recordable in accounting. And when you think of these transactions, make sure the recordable ones are things that always deal with the monetary value, but non-recordable don't deal with the monetary value. And I would definitely love to see your thoughts, love to see your answers in the comments, so that I can provide you feedback and tell whether you have got this right, so that you know well that you've understood the process of accounting clearly. So take a few minutes and mention two transactions that are recordable and non-recordable. Alright, so with that, I hope by now you have thought of the transactions. And even if it's not the case, you can still pause this video, think of the transactions, put it in the comments box, and then you can move on with the video, right? So now I'm going to talk about the second stage of the accounting process, which is recording these transactions. Now that you've identified what kind of transactions you're going to record in accounting, now you're going to record them properly, right? So when you record the transactions, we need to mainly focus on three main things. First, source documents. Basically, source documents are the proof that you need. Like for example, when you go and buy a meal from KFC, you're gonna get a receipt. Well, that receipt is an evidence to say that you've paid for the food that you've ordered. So that is a source document, because for the customer, for you, it's an evidence that you paid. For KFC, it's an evidence that they've received money. So those are source documents. That's the first step where transactions are recorded. Secondly, books of original entry. All these transactions that are recorded in source documents are later on separated according to the source document. Like you will see later on that we have different types of source documents based on the different types of transactions. We're not going to put all the transactions in one source document, mainly because we need to keep our transactions well organized, because in a business millions of transactions happen per day most often. You may buy a machine, you may sell a machine, you may pay a investor, you may pay a supplier, you may get money from a person who owes you trade receivable. So there are different types of transactions. So to record all of these, we have different types of source documents, just to make it more organized. And to make it even better, we have different categories of books of original entry that are directly linked with each source document, which makes the process quite easy, because once the recording process is itself organized in an orderly manner, it's really easy for the accounts department or the person in charge to just summarize and analyze the transactions, because accounting is actually key for the whole business, as it is the main channel of communication for a business. And communication needs to be done very fast in a business. Even a single minute wasted can land in a wrong decision, and that can lead your business to fail. So therefore, knowing how to record these transactions is very important. And once you record in the books of original entry, a further reorganization is done into something called a ledger, where the transactions are going to be posted into individual accounts. Like say for example, if you have 10 customers, you're going to record for each individual customer the transaction separately, and that makes things even easier. You can check, okay, for example, I want to see how much Ron owes me. I can go to the ledger, check how much does Ron owe me. I can have a full look at all the transaction that has happened with Ron, and that makes life really easy for a businessman, for people involved in business. So recording transactions is actually a very crucial stage of the accounting process. And previously, before the improvement in technology and all of that, these were all done manually, and it was a hectic process. But today, most of these things are done using software packages, and they can just be recorded in minutes, because the programs are already programmed in a way that the transactions, when you record it in one place, it automatically gets recorded in the respective books of prime entry, ledger, etc. You can auto-generate summaries and analyze the results. So, as I mentioned before, recording the transactions is a crucial situation. So you need to know what you need to do exactly in this case. So when I talk about the source documents, as I mentioned before, it's the proof that you have. So the source documents that are related to transaction that happen through cash are mainly a receipt and the payment voucher. So to indicate that you have received cash, you have the receipt that you have issued to the customer. And to indicate that you paid someone, you have something called a payment voucher. So all the money that you receive and that you pay are going to be recorded in the receipt and payment voucher, first of all. And then later on, maybe at the end of the day, at the end of a week, or at the end of a month, depending on the business, you're going to record these details in a book of prime entry or an accounting book called a cash book, where only cash transactions are recorded. Now, when I talk of cash, it includes the cash they have on hand as well as the cash that they have in their bank accounts. So anything related to cash is recorded in the cash book, and it will always be recorded using the data in the receipts and the payment voucher. So that's the importance of this type of source documents. Secondly, the purchase journal and sales journal are the books of prime entry or accounting books that we use to record purchases and sales that are done on credit. That means when you buy stocks on credit, you buy today and you pay later. Then you record it in the purchase journal. Sales journal is the book you use to record when you sell goods, like sell stocks and take money later. So first of all, when such a transaction happens, you record them in something called an invoice. And once the invoice is issued to a customer, or once you get an invoice, that means you need to pay that amount within a given time period. And only when it's paid, it becomes a cash transaction. That's when you get the receipt. So basically, for the purchase journal and sales journal records, the source document, the proof that we use is the invoice. So, as you saw before, the credit purchases and credit sales are based on the invoice, and then the source document for the purchases returns and sales returns is credit note and debit note. So, these are the main source documents that can be used in the accounting process. Now, all of this is done based on a system called the double entry system. So basically, the recording of transactions are done based on the double entry system, and this is known as bookkeeping. So recording the transactions is known as bookkeeping, and this double entry system is actually a process that has been introduced, or a system of recording that has been introduced by Luca Pacioli, the father of accounting. And in this case, the system says that all of the transactions have at least one effect which is positive or negative. So these positive effects are equivalent to the negative effects, and they can be recorded in accounting in terms of a debit and a credit. So, according to this, each transaction will definitely affect the resources you own and how it's funded. So the accounting equation that you can form out of it is that assets equal liabilities plus capital. That means all of the resources the business owns is either funded by the owner himself or by an external party. For an example, owner invested 2,000 in cash. So cash is increasing by 2,000 and the capital increases by 2,000. Purchase motor vehicles on credit, assets increase and liabilities increase because you need to pay them. So likewise, according to the double entry system, of course, each transaction has definitely two effects. which can be recorded in terms of the accounting equation. And when we record it in terms of debit and credit, you need to remember this shortcut. All assets and expenses, when they increase, you debit it. Any capital, liabilities and income, when it increases, you need to credit it. Now, how do we identify this? An asset is any resource of the business, like vehicles, land, etc. Expenses are what you need to pay for a business, like rent, etc. Income is what you earn out of the business, like sales income. Liabilities is what you have to pay to your lenders, like you need to pay it in the long term or the short term, but you've taken it as a loan, you bought on credit. And capital is the owner's investment. So depending on the effects of the transaction to these categories, whether it's recorded as a debit or credit will change. Now, I would like you all to take a few minutes and try to identify a few examples for assets, expenses, income, liabilities, and capital. And don't forget to put them in the comment box so that I can see if you've understood it properly. Now, as I mentioned before, depending on these transactions, how it's debited and credited will change. So just to give a better idea, when you have a cash purchase, that's buying on, like you buy it and pay at the same time, then your expenses are increasing because you're buying. So your purchases account is debited and your cash is decreasing. Cash is an asset, so it should be credited. So it's the same logic that you need to follow throughout the different types of transactions, and these are just a few examples of transactions that you might meet in businesses. Now, all of these transactions, once they're recorded in the proof documents, you need to record them in proper accounting books. And the first set of accounting books that you make use of to record this properly is known as the books of prime entry, or we also call it the books of original entry. So all the credit sales of stocks are recorded in sales day book. Credit purchases of stock recorded in the purchases day book. Sales returns of stocks recorded in the return inwards or sales returns journal. And purchase returns are recorded in the purchase returns or return outwards journal. Now, as you can see, all of these books have the same format. You have the date, the details to whom you sold or you bought the goods from, the invoice number or debit or credit note number, and the amount. So these are the basic details that you need to record about these transactions. So these are four main prime entry books that we use in accounting. The next two are the cash book and the general journal. The cash book, as we discussed before, as we came across before, is used to record all the cash transactions for the money that you have in hand and the money that you have in your bank account. So you record the receipts and your payments also. Now, when you compare the details you record in the cash book, it's very important to know that the cash book is a special book because it's the only book that has debit and a credit side. So we call it as a book of prime entry and a ledger. So it's a dual role-playing book. Whereas all other transactions that you can't put into the previous books, we record it in the general journal. And because general journal has miscellaneous transactions, usually after each entry we give a small narration, a small summary of the transaction we've recorded, and you can see how this is done in the picture here. So with that books of prime entry being used to record those transactions, now you need to put them in individual accounts. So to put them in individual accounts, we make use of something called a ledger. So when we talk of the ledger, we actually have three main types of ledger. The sales ledger, where we record all the individual debtors accounts. That means if someone has bought goods from us and they have not paid yet, basically if there's a credit sale that has been done, then those individual accounts will be recorded in the sales ledger. So you can see how much each of them owe your business, and you can see all the transactions that has happened between your business and this person in the sales ledger. Purchases ledger is actually the opposite of it, where you have the individual accounts of the creditors or the payables, the people or the businesses to whom you need to pay because you purchased products from them on credit basis. And finally, the general ledger has all other T accounts except for the debtors, creditors, and the cash and bank. Except for these 40 accounts, all of the other individual accounts are recorded in the general ledger, like the total sales, the total purchases, the total sales returns, total rent, etc. So as you can see now, the link, first we start the recording with the evidence, then we move down into the first set of books, the books of prime entry, streamlining down into individual accounts that are recorded in the ledger. And with that recording process done, in accounting, the next main thing that we need to focus on is summarizing these transactions. So at the end of a certain period, so once we're done with the summarizing of transactions, we need to analyze these transactions. We need to see how much of profit or loss the business has earned, what is the current financial position of the business. So to look at these things, what we do is we prepare the income statement or the trading and profit and loss account, and also the balance sheet, or we also call it the statement of financial position. Now, these two financial documents are usually produced annually, but depending on the business, they can produce it at any time. And it can be in horizontal or vertical format. And depending on the exam syllabus you're following, the format will differ. But irrespective of the fact, the same information are indicated. So with that analysis, the most important part of the accounting process is making use of something called ratio analysis, which is actually used to communicate the transactions of the business, to talk about the liquidity of the business, to indicate how much of cash we have in the business, how much is the ability of the business to convert the resources into cash, etc. And also to talk about the return for investors and the gearing situation, how much you owe to others, the profitability, how far the business is successful, and in terms of the financial position, in terms of how quickly they can make money, how quickly they can get money from whom they owe. So these key things are important for the stakeholders of the business, for anyone who's linked with the business. So communicating these transactions is very important in the accounting process, and it's kind of like the main crucial part of it. Because even though the records, the analysis, all are done properly, but if you do not communicate the information properly to the stakeholders, incorrect decision making can land into a bigger problem for businesses. So who are these users of this information? It's generally all stakeholders. That's anyone who is interested in a business can use this accounting information. Like, for example, investors. They will be interested in the profits to see how much return they can get, or to see whether it's worth it to continue investing in this business. The management may be interested in the profits to see whether there is progress in the business and what kind of plans they got to make for the future. The employees, on the other hand, may be interested in the information to look at how much of money they can earn from this business, and competitors to see how this business is doing well, what strategies they've used, and what strategies they can copy, etc. So basically, this accounting information can be used by different people, but for different purposes. So irrespective of that fact, this is a very important process. So accounting is actually a very important process for businesses, and I think by now you know why you need to be studying accounting. And if you're taking accounting as a subject, I think you have an idea on what kind of things you will be studying in accounting. So if you have enjoyed this video, I hope to see your feedback and comments, and also don't forget to answer the questions that I've raised during the video so that you can get individual feedback just to confirm that you've made proper use of this video. And if you found it useful, don't forget to share it with your colleagues so that the others also can benefit out of it. Finally, thank you for watching the video, and for more of such videos, don't forget to subscribe to my channel, and looking forward to bring more and more resources to you that will help you in your coursework and day-to-day assignments.